Continue with our Chapter 2 video lecture. We focus on the assets section of the balance sheet. We'll now look at the liabilities and stockholders' equity section of the classified balance sheet. So on the liabilities section, you have your current liabilities as well as your long-term liabilities. Current liability or obligation that will be paid within the next year or within the operating cycle, whichever is longer. So it is the due date that determines whether a liability would be considered a current liability or a long-term liability. So typically, if the due date is within 1 year from your balance sheet date, you record it as a current liability on the classified balance sheet. Again, if the debt due date is within 1 year from your balance sheet date, typically we're going to record it as a current liability on the classified balance sheet. Examples are items such as accounts payable, salary, wages payable, notes payable, income taxes payable. Typically, these are liability accounts that are going to be due within 1 year from your balance sheet date. Now, there is something known as the current maturity of long-term obligation. Perhaps you're saying, what does that mean? I am glad you asked that question. So think about a mortgage. Some of you may be too young for that, but some are not. Let's say you have a 30-year mortgage for the purchase of your home, which means you're making a payment over the next 360 months to that finance company. Now, of course, you're going to make a payment every month, right? So the 12 payments that are going to be due within the next year are referred to as the current maturity of a long-term obligation. So on the classified balance sheet, we're going to separate that portion that's due within 1 year from the amount that's due in a time period longer than 1 year. So if you think about think about your car note. If you have a 5-year loan on your car note, again, the amount that's due within 1 year from your balance sheet date is recorded as a current liability. The remaining section is shown as a long term. Going back to an example of Google Incorporated, this is showing a partial balance sheet of the current liabilities. They had accounts payable, short-term debt, accrued compensation, accrued expenses, and other current liabilities, income taxes payable. So you'll learn more about these terminology as we go along. So I'm going to stop here to make sure that you are reading these textbooks or your ebook, because in accounting, there's a lot of terms used in accounting. And if you don't understand the terminology, it's hard to do the actual work. Okay, commercial break over. So notice that we get a total for the current liabilities section. Again, these numbers are in million. So they have current liabilities of about $14.3 billion worth of current liabilities. Long term is just the opposite. Long term means that these debt will be paid after 1 year from your balance sheet date. So you could have bonds. We have a whole chapter about bonds coming out, chapter 10. Notes payable, long-term notes payable, lease liabilities, pensions, mortgages. So again, if it's a long-term liability, it is an obligation that will become due after 1 year from your balance sheet date. Okay? The stockholders' equity section of the classified balance sheet really stays the same. It just shows the common stocks, which is the investment of assets by stockholders. As we mentioned back in chapter 1, when a person buys stock in any corporation, they become a stockholder. They become part owner of that business organization. So the common stock section shows the amount of money we have received from the investment and the stock of our business. And then retained earnings shows that portion of the income or our profit that has been retained for use in the business and not paid out to the stockholder in the form of dividends. And as we mentioned before, the balance sheet still has a balance. When you add your assets, they must equal your liabilities plus your stockholders' equity. So make sure that you understand those different categories of the classified balance sheet, understand the different type of assets, current assets, long-term investments, PPD, intangible assets, current liabilities, long-term liabilities, and your balance sheet must always, always, always be in balance. Your assets must equal your liabilities plus your stockholders' equity.